Imagine working your entire life, paying off your mortgage, building up some savings, and then the government takes 40% of it before your children see a penny. Most people think that only happens to the wealthy. It doesn't. And it's about to affect a lot more ordinary families than anyone is admitting. By the end of this video, you'll understand why inheritance tax is affecting more families every year. The April 2027 pension change most people have completely missed, and the legal steps families can take right now to protect what they've built. Imagine your parents bought a house in 2009. A normal family home. Nothing extravagant. They worked hard, paid the mortgage, raised a family. They never considered themselves wealthy, and they never worried about inheritance tax. Then something happened. House prices moved. The threshold didn't. The standard inheritance tax threshold is £325,000. It has been frozen since April 2009, and it is now confirmed frozen until at least 2031. That means a 22-year freeze. Meanwhile, average UK house prices have roughly doubled. That's the trap. The government doesn't need to increase inheritance tax rates. It can leave the threshold exactly where it is and let rising property values pull more families into the system. Every year, more estates cross the line, not because families became wealthy, because the line never moved. House prices moved. The threshold didn't. HMRC inheritance tax receipts reached £8.4 billion last year, and they keep rising. Most people have absolutely no idea this is happening. Think about that. More families are paying inheritance tax every year, yet the rate has not changed. The government did not need to increase the tax. It simply left the threshold where it was and waited. That is why this catches so many people off guard. Nothing looked different until the bill arrived. Most people think inheritance tax is a rich person's problem. Let's test that. Imagine a home worth £400,000. Savings worth £100,000. Total estate value, £500,000. That sounds like decades of work, not extreme wealth, but above the £325,000 threshold, £175,000 becomes potentially taxable. At 40%, that's a £70,000 tax bill. Not on a mansion, not on a private jet, on a family home and a lifetime of saving. Families in London and the South East are particularly exposed because house prices alone can push estates above the threshold. There is protection available. A single person can potentially pass up to £500,000 tax-free when leaving a home to direct descendants, and married couples or civil partners can combine allowances to pass up to £1 million tax-free. But most people don't know that, and if you don't understand the rules, you can't plan around them. Which brings us to the part almost nobody is talking about. And if you think your pension protects your family, pay attention. Because from April 2027, unused pension funds will become subject to inheritance tax. Most people watching this video have never heard that sentence before, but it could completely change how families pass wealth to the next generation. Right now, unused pensions sit outside the estate. That makes them one of the most powerful tools families have for passing wealth to the next generation. Many estate plans are built around that fact, but from April 2027, that changes. Anyone who has included pensions in their inheritance planning needs to know this is coming. Because once the rules change, you can't go back and plan earlier. But this isn't about panic. It's about preparation. The wealthy pay advisors to explain this stuff. Most ordinary families never hear it. So here are 5 things worth knowing. First, understand your allowances. Married couples and civil partners can potentially pass on up to £1 million tax-free. Second, gifts made more than 7 years before death are completely free of inheritance tax. Every year someone waits is a year they can't get back. Third, gifts to a spouse or civil partner are always tax-free. Fourth, leaving 10% or more of an estate to charity reduces the inheritance tax rate from 40% to 36%. And fifth, Review pension beneficiary nominations before April 2027. That change is too important to ignore. Here's the real lesson. The families who get caught are rarely the families who planned. They are the families who assumed inheritance tax was somebody else's problem. Inheritance tax isn't catching more families because Britain suddenly became full of millionaires. It's catching more families because house prices moved. The threshold didn't. And while ordinary families assumed inheritance tax was somebody else's problem, the line kept getting closer. Your parents didn't spend decades building a future so a frozen number from 2009 could decide what your family keeps. But that is exactly what is happening. If you enjoyed this video, subscribe for more.